Okay, well, we're going to finish our discussion of taxes in your financial plan with a discussion of different information sources, audits, and then some tax strategies, which I hope will be a bit illuminating and help you protect yourself against the wiles of real estate agents. Slide 31, tax information sources. The IRS has several methods of assistance now, and they are much better than they used to be, folks. They really are. The 800 number, the website, the email service. If you have questions, they will help you. Excuse me. One time I had a real tough question, and I sent it to them, and they didn't get back to me within a couple of days, which they normally do. And then they finally got back to me and said, work on it, relax, we have to find the right person. And then in about a week, I got a message back, and I had already found the answer through another means, but they had done their research and got it correct. It was a tricky one. The tax publication J.K. Lasser's Your Income Tax is quite useful. And what you can do is you can pick up the current year's edition after the tax season, because people just throw them away, and you can learn a lot just from looking through that, even though you need to take a look at the current year when you're doing your taxes. The internet is an unbelievable source of drivel. I mean, good and bad information, so be careful. IRS.gov is great. And that's part of your assignment, is to go to irs.gov and look up some answers. And you can use other websites, but as I mentioned in the assignment commentary and on the assignment, be careful. Make sure you get the right information. Make sure you get the right year. Slide 32. Tax preparation software. You know, it's come a long way, folks. Tax preparation software has become very popular and very useful. TurboTax is the giant, but they've done a few things the last few years to anger their constituents, and a lot of people have moved on over to H&R Block at Home, TaxAct, TaxSlayer, and there are many others. And it's been a bit of a dent in their sales. So check them all out. They'll usually let you do it for free, using your browser, using your mobile device, until you go to file, and that's when they're going to charge you, right? So hey, you can figure out it all beforehand, and then just copy it down onto the forms and send it in. I'm a big fan of spreadsheets. I have spreadsheets that I've had for decades that I use to maintain the tax data and the various income and expense categories, and then I then type it into one of the programs and let the program do all the work. The most important work is keeping track of all your deductions and all your expenses and all your income. I mean, that's the hardest part, especially when you have a side business or real estate or something like that. If you just have your W-2, it's not that hard, folks. It's really not that hard. So check out one of these programs. Some are free. Some are, free until you go to file, and then they want to charge you. Slide 33. What about a tax preparation service? Well, tax preparers have gotten better. The IRS has created a registration and testing process for tax preparers. But if you really need somebody professional, you want an enrolled agent, an accountant such as a CPA, or a tax attorney. Enrolled agents tend to be the most prestigious. These are people who have been approved by the IRS. Often they're ex-IRS agents, and they are the heavy guns. But of course an attorney is also a big gun. And CPAs, CPAs sometimes know their stuff cold. They're fabulous, fantastic. And other times they sort of just use their program and just, it looks good to me. Okay, fine. Here at Southwestern, we have the program called Vita, or Vita, volunteer income tax assistance, and it's other places too. I volunteered last year, excuse me, and enjoyed myself immensely. But this year I probably will just do a little bit of volunteering, not much. I think we're going to have it on Fridays afternoons again, during all day Friday. I'm not sure. So check it out. If you qualify, you get your taxes done for free. Very cool. If your professional tax preparer makes a mistake, guess who's right? You are. You're the one signing it. And it used to be that some of these people were real scam artists. They would just say, hey, how much did you pay in taxes last year? Oh, $4,000. How'd you like to pay $400 this year? Yeah. And then, of course, they'd file a return with bogus deductions or hide some of your income. And you signed it. So now you're in trouble. And he's gone. Who knows where he went. So for this reason, it is important to at least understand the forms you are signing and check that the numbers are reasonable. And again, once you go through the Form 1040, I think you'll find that it's not as scary and horrible as people make it out to be. Because what might happen? It's slide 34, tax audit. Relax. Many, as the IRS reports, are just because of arithmetic errors, and it's far less than 1%. If you claim large or unusual deductions, you are more likely to be audited. So if you're in the higher tax brackets and have lots of deductions, then yeah, you might wind up being audited. Although I think they have a random audit where they audit people randomly. And so even if you have a 1040 EZ, they could audit you. There are three types of audit: the correspondence audit, the office audit, and the field audit. The correspondence audit is the simplest. That's the one where they send you a letter saying, hey, you said that you paid $500 to some charity. Please send us a copy of the receipt. So you make a copy of the receipt, send it back to them, and they'll send you something saying, cool, that's good, we're done. All right, it's over with. Or maybe we need now this. The office audit is in between the correspondence and the field, which is the worst. And that's where they ask you to come into their office and bring this, that, and the other thing. And you come into their office, you bring this, that, and the other thing. You don't say anything else other than good morning or good day, good afternoon, and goodbye. Don't try to finesse it. Don't try to bring anything that they didn't ask. Just do what they say. Now, if they want to do a field audit, they have to give you time. They can't just swoop in. This is the most complex. The IRS agent wants to visit your home, your business, your accountant's office. They smell smoke. They think you're hiding income or padding your expenses or doing something untoward and possibly illegal. And so they're sending out their bloodhounds. If you are chosen for a field audit, that's when you need the enrolled agent. That's when you need a CPA, a tax attorney. You give all the materials to them, and the field agent then goes to their office. You're not even there. Do you understand? Don't try to do battle with these people, because it's their job to sniff out fraud and tax evasion. I have a little story where my brother-in-law was called into the IRS office for some problems that he had with the IRS, and he worked them out. They were definite problems, and he worked out. But he went there, and this was in the New York office. New York, very, very fancy. He saw a grown man in a three-piece silk suit, sobbing hysterically. Yeah, they caught the guy. They had him dead in his sights, and they caught him, and he was, he's probably going to go to jail. Who knows? But my understanding is with these infractions for taxes, they let you work on the weekdays, and then you go to jail on the weekends or something. Because they want their money back, right? And it doesn't do them any good to put you in jail because they can't get their money. So I don't know if that's true. I heard that. I don't know if it's true. Slide 35. Let's take a look at some tax planning strategies. Most notably, we'll take a look at the home ownership, the mortgage deduction, which is the biggie. Because there are two time-tested tax planning strategies: tax evasion and tax avoidance. Which one do you think? Right? Evasion is illegal, not reporting all the income, hiding income, padding your expenses and the like. Yeah, that's can send you to jail. Now, in days gone by, as we said, they tied you to a tree and whipped you. They don't do that anymore, but it feels like it. Tax avoidance, though, dear students, is totally legal. It is your duty, and some might say it is your right, it is your responsibility to reduce your tax obligation to your fair share, but no more. So if you believe it's a legitimate expense, take it. And if you need to get some guidance first, go ahead and call a professional, but take it. The worst they're going to do is say, no, it's not right. You have to pay back the amount you took away, but with interest and maybe a penalty if they think you were not sincere in your belief. Americans avoid about 50 billion in taxes. That number I've seen much higher. I've seen it much higher. By annually hiding their money in offshore accounts. Yeah. And so for a while there, I'm not sure if they're still doing it, the IRS had this amnesty program where you could bring that money back to the United States, pay taxes on it, and they wouldn't go after you for criminal tax evasion. I don't know if they still do that, but they did. So let's take a look at some strategies. Now, the problem with these is that most of them are either not that fabulous, it turns out, or they're not designed for the working grunts of the middle class. In fact, some of them are just downright wrong. People will cut off their nose to spite their face when it comes to taxes, so they can pay a few less dollars in taxes. They'll spend a lot of money, which doesn't make any sense, in my humble opinion. And one of them is tax-deferred annuities. These things we'll discuss when we get to Chapter 11. Yeah, they're great for some people who've got a lot of money to burn, but for the vast majority of us working grunts, stay away from these things. They have very high fees and usually not very good returns. Series EE Treasury bonds. Yeah, yawn. These are great for newborns, and you give them to your niece or your newborn nephew, because then when they turn 18 and go to college, they can cash them in and not pay any taxes, which is kind of cool, but most people forget about them, leave them in the drawer forever and never redeem them. How about the tax-deferred retirement plans at work? Now we're talking, folks. We're going to spend a lot of time talking about these things later on because these are cool. 401ks, 403bs, Roth IRAs, education IRAs, 529 plans. The Roth is better. And then if you're self-employed, you might be able to get a SEP IRA. We'll discuss these when we get to retirement, when we get to investing, because these can be very, very powerful. Long-term capital gains are what you receive if you hold an investment for more than 1 year. And it turns out that you're taxed at a much lower rate than your income. This is a tremendous boon to people in the very high tax brackets. So what they do is they convert a lot of their income into capital gains and pay fewer taxes. But for the most part, those of us at the lower end, it'll help. It's not bad. Owning a home, slide 37, is one of the best tax shelters because you can deduct that mortgage loan interest and the property taxes when you itemize. This reduces your taxable income. This is a paid advertisement from your friendly local real estate agent. Because as we're going to see, the tax savings, especially for people at the lower end of the housing market, the tax savings are not that great. There's nothing to sneeze at. I mean, you love to pay fewer taxes, but you don't buy a house just because of the tax benefit, in my humble opinion. We'll see that in a bit. The book suggests that maybe you want to use your home equity line of credit to buy a car, consolidate debt. Ooh, We'll talk about this in detail when we get to Chapter 5. Not the best course of action, folks, unless you're very squeaky clean. Because sure enough, if you don't pay your credit card debts, that's not good. It wrecks your credit rating. But if you don't pay your home equity line of credit, it's like not paying your mortgage. They could take your house away. So I'm not a big fan of these things until after you've learned how to tame them and use them to your advantage. Municipal bonds, tax-exempt investments, they're for the very wealthy folks, as we'll see when we get to investments. And then starting a business. Not a hobby, a business. We'll discuss that too. But first, let's look at some home tax planning examples. Slide 38. Here we have a single individual and a married couple, both with an adjusted gross income of $50,000. Remember, this is after they've taken away any adjustments to income, but before the deductions and the personal exemptions. So if they don't have that home mortgage interest deduction, it's very unlikely that they're going to go over the standard deduction. So they'll take the standard deduction, which is what we see here. The single person reduces their taxes from their adjusted gross income from $50,000 to $43,700. That's $50,000 minus $6,300. And then gets one personal exemption because they're a single person. And they're looking at a taxable income of $39,650. If we go into the table, that single person is paying $5,690 in the year 2016. 2016. Should be 2015 taxes, right? No, 2016. I'm sorry. I'm getting confused. I'm getting old. 2016 taxes, right? The one we did. We looked at the tax table. Yes, you did. So $5,690. And make sure I did it right. $39,650 for single, $5,690. That's almost $500 a month. The married couple gets the standard deduction of twice the single person, or $12,600. So the subtotal is $37,400. And then there are two of them, so there are two personal exemptions, and we're down to $29,300. So looking into the table for a married couple, we find that they're paying $3,471. So they want to reduce their taxes, and also they want to get into a home. So they go out and buy a home at the lower end of the housing market, a condominium or maybe a home somewhere. And here is their Schedule A. And this should look familiar because this is a King Backs Schedule A. Yeah, it is. It's the same one. So we had a $1,000 income tax, state income tax. There's the real estate property tax that you get to deduct when you buy a home. The DMV property tax, whatever, registration for your vehicle. And then here's the one we spent some time on, mortgage interest. And you thought I was kidding, right? So it's $360,000 loan at 4%. That's $14,400, $1,200 a month. Yeah, and that's at the low end. So your payments are what, $1,800 when after you pay the property taxes and the principal and interest and the insurance, $1,900. Yeah, but still, some people are paying that in rent, right? And then gifts to charity. So now we're looking at $19,000. So what we're going to do is, instead of using the standard deduction, we're going to use the itemized deductions, because you get to take the standard deduction or the itemized deductions, but you can't take both, right? So we take the $50,000 adjusted gross income and subtract the $19,000 of itemized deductions, and we're left with $31,000. Now, the single person has one personal exemption. The married couple has two. So now we're looking at $26,950 taxable income, line 43, that we go into the tax table for the single person. And we come back with $3,583, about $300 a month. And the married couple, $22,900, we go into the tax table, and they're paying $2,511. And so when we take a look at the savings by buying the home, we find that the Single person is saving $2,000 a year, which is nothing to sneeze at, about $180, $190 a month, but, not a tremendous amount, enough to pay for the HOA fee. And the married couple is only saving $80 a month, $960, which barely pays for the utilities, right? So for married couples, especially buying at the lower end of the housing market, the tax savings are not as large as the real estate agents make them out to be. Now, I had a real estate agent jumping up and down in my classroom saying, "What are you trying to do? Are you trying to dissuade people from buying a home?" And I said, "No, not in the least. That's not my goal. That's not my objective. My objective is that you understand what's going on. So that when you buy a home, you don't buy it for the tax savings. You buy it because you want it to be your home. And you just smile and shake their hand when the real estate agents jump up and down and scream and holler about how much you're going to be saving, when they either don't understand the savings or they know full well it's not as much as they're making it out to be." I have a tendency to believe that there are people in the industry who really don't understand how much that the new couple or the single person is going to save, and there are people who understand all too well. So I'm pretty sure it's a mixed bag, because don't worry, we're going to insult everybody by the end of the semester, but the real estate agents are like parrots. They grab onto these sayings and they just say them over and over and over again, and that makes them learned and wise and hopefully in their case successful. But let's take a look at people who are moving up into the upper middle class, where now we're making not a bad salary, folks. $80,000 of adjusted gross income. So bottom of page 1, top of page 2 of the Form 1040. Well, without the home deduction, they get to take advantage of the standard deduction. Again, $6,300 for the single person, $12,600 for the married couple. The single person has one exemption, the married couple has two exemptions, and the single person is looking at $69,650 for their taxable income, and that translates into $13,190. Right, $1,100 a month. Yeah. The married couple is looking at $59,300, and they're paying $7,971. Right, a little less than $700 a month. Wow, wouldn't we like to be able to reduce our taxes? Well, yes, we can. By buying a home in the mid-range, maybe a little bit more, we can reduce our taxes substantially. So let's take a look at the Schedule A for somebody who's bought a nice house way up on the hill where they do the boogie and look down upon us peons. $2,000 of income tax, $5,000 of property taxes, maybe even more. DMV property tax, $400, and look at that mortgage. Woo-wee! $28,800. These people are paying about $4,000, $3,600, $3,500 a month, depending on what they got. Yeah, 20. And does the IRS blink when they see that? If you live in Southern California or New York or one of the very expensive urban areas, or Northern California where it's even worse, no, they go, yeah, it's typical. That's what people pay. They give more to charity because they have more, and now they're looking at total itemized deductions of $37,000, a serious chunk of change. And so what does that do to their taxes? Well, instead of the standard deduction, they get to take the itemized deductions of $37,000. That reduces the gross income, just the gross income, to $43,000. Then the personal exemptions, $4,050 for the single, $8,100 for the married couple. And now we're looking at taxable income of $38,950 for the single person, $34,900 for the married couple, and their taxes have been reduced substantially. $5,515 for the single person, $4,311 for the married couple, So the tax savings are pretty darn good for the single person, right? They went from $13,000 down to $5.5, $7,675, or almost not $670, something like that, between $600 and $700 a month. That's not bad, but they have a pretty big mortgage. And the married couple has gone from almost $8,000 to a little over $4,000, or they're saving about $300 a month. Again, nothing to sneeze at. Once your income reaches the middle to upper middle class level, a home is normally a very good tax shelter. So we want you to have your eyes open when you go shopping for a home, if you do, so that you don't fixate on this tax savings, because owning a home is almost always, in the short term, more expensive than renting, assuming you rent something that's much more modest than you would buy. Yeah, and we'll discuss this more in detail when we actually get to housing. Enough said. So go back there and make sure you understand those two different propositions. And obviously, when your income starts to rise substantially, then a tax savings from home ownership is quite large, and that's why some people think that they don't like that mortgage deduction, because they say it mostly helps the very wealthy. Well, don't forget that they might get hit with the AMT if they right. So they start bumping up against the alternative minimum tax, and then they're So it's a lot more complicated than anybody can imagine. You start pulling back the layers, and it's like an onion. There's more layers underneath it, and some of them are a little rotten. Slide 46. Home business example. Remember that $299 stereo that wound up costing us $535? Well, if it's a legitimate business expense, then that same $299 stereo cost us just $319. How can that be true? Well, you still have to pay the state sales tax unless you plan to resell it as retail. Unless you're going to turn around and sell it to somebody else, then you don't have to pay the sales tax. You'd be a wholesaler then. But you also get to deduct that state sales tax as a business expense. So we wouldn't have to go out and earn all that more money to pay for that stereo. But when would a stereo be a legitimate business expense? You have to think. When would that be true? Well, if you're a DJ, certainly it's true, right? Or if you have a store or a waiting room where you need music, that's a legitimate expense. Home businesses can be very profitable and a good tax shelter, but you have to make money after a certain amount of time. You can't just simply lose money every year, because what will happen is the IRS will eventually come in and say, it's a hobby, not a business. And then they'll go back all the years that you took deductions for and lost money, and they'll disallow them. Right. And the rule of thumb is after about 3 or 4 or 5 years, you need to be starting to make money, or else they're going to come after you. So I have a cute little story. I hope you will allow me to indulge myself with this story, because it really is adorable. I do the taxes for my families and friends. Why? Because they knew I did them for ourselves. And I started with my sister-in-law, who got literally charged an outrageous amount of money to do a 1040 EZ. And I said, Kathleen, I'll do it for you. Just babysit for us. This was many years ago, folks. And so then, of course, her daughter asked me if I could help, and their other daughter, and then so one of their daughters, one of my nieces, started a theater production company with her friend, her longtime friend. They're both excellent thespians, which is a fancy word for actresses. And believe it or not, they started off making money. They called themselves Backyard Productions, and they had very minimal sats, and they didn't pay anybody. They were some of the actors and the other actors were doing it all for free, and they were charging tickets, and they actually started off making money. And then what happens, it's just expected that you're going to start indulging. You're going to start using more expensive sets and doing more expensive plays and venues that are more expensive. And your expenses just skyrocket. They've got more and more critical acclaim throughout the city and started losing money. So there you go. You know, how much is your art worth to you? And they started losing even more money. And I said to her, to my niece, I said, you know, I don't know. My understanding is you got to make money before you can continue to write this off as an expense and as a loss on against your income. And so she asked me, what should we do? I said, I don't know. Let me go talk to the IRS. Let me go call the IRS. I called the IRS, and it took me a while to get to talk to the right person. And he called me back and said, well, how can I help you, sir? I said, well, we have a business proposition here, business enterprise that's was making money, but now it's losing money, and it looks like it's going to continue to lose money. We don't know what to do. And he said, well, what kind of business is it? I said, well, it's a theater production company. And he roared with laughter. He just thought that was so, oh, you go right ahead. You know, go right ahead. Theaters, oh, they always lose money. Don't worry, your little head. You go right ahead and lose as much money as you want in the name of art. And I thought, okay, if that's the case, I mean, they obviously must see it, that you know, theaters just never make any money. And so I told that to my niece, and she said, you know what? I don't think I want to continue doing this. I don't want to keep losing money. So they stopped doing it because they were just looking at, you know, red ink, as the saying goes, in perpetuity. So I thought that was a cute story. Hope you enjoyed it. And but they actually then went back and did a couple of things, but you know, nowhere near as big as they had done before, because they just didn't want to continue to lose money anymore. Slide 47. Donate your car, get a tax break. Now, this is something we've already touched upon when we discussed the standard deduction versus the itemized deduction, so hopefully it will make sense now. An all too familiar spiel we hear from charities these days is that you can donate your car and get a $2,500 tax break. They don't mention the amount anymore. I'll tell you why, right? Well, in the 25% tax bracket, a $2,500 deduction is worth $625, and you might only get $50 in cash if you ask the recycling yard. We don't use the term junk man anymore. It's pejorative. If you ask them to come take it away, they might give you $50 for it. They probably just say, look, you're lucky we're taking it away for you, okay? Not a bad deal. Not anymore. The charity must now immediately sell the car and tell you the actual amount they received for the car. So if it's only worth $50, that's probably what you're going to get as a deduction. And as we said, and I hope you understand, if you don't itemize, if you don't own a home, for example, and have that huge mortgage deduction, and instead take the standard deduction, then you can't take advantage of it. You show, hey, I got a tax deduction for $600 or $1,000. Well, you get $6,300 if you're single, $6,300, $6,300, exactly, $12,600 if you're married. So, oh well. And then they get upset. They go back to Father Joe's or whatever charity they were dealing with and say, you told me I was going to be able to get a deduction. And they say, well, we told you may be able to get a deduction. Consult your tax professional. So I'm not trying to tell you not to donate, okay? Don't get me wrong. I'm not trying to tell you don't donate your car because it's a good cause. Go right ahead and do it. But just realize that you might not be able to use that charitable deduction. Okay? Good. Slide 48. The bottom line on taxes. Right. Death. And the only thing that we can be sure of in this lifetime, as Mr. Benjamin Franklin, we'll see Mr. Benjamin Graham when we get to investments, is death and taxes. Well, actually, Ben was wrong. The only thing certain in this life is death, taxes, and tax law changes. So we're going to see some tax law changes let's hope that we can play nicely in the sandbox together and do a good job. Pay your taxes. Quit. Oh, you can complain all you want. Go right ahead. Just go right ahead and complain. But realize that taxes are the price we pay to live in a civilized society. And if we want real tax reform, folks, I'll tell you all we have to do is require the senators and representatives, House of Representatives in Congress to do their own tax returns. See, they don't have to do their tax returns. The IRS sends people up, or maybe it's the General Accounting Office, and they do the senators and they do the representatives' tax returns. So if they were required to do their own tax returns, oh boy, we would see some reform happen. We would see some simplification happen. But don't hold your breath. So, how do you feel now? Go back over these, study these, because you now have a pretty good idea of what it's like to own a home and what tax benefits you'll get from them. And if you don't, then you can see it's really actually pretty easy to do your own taxes, so you won't get charged a gazillion dollars by H&R blockheads. H&R Block to do something that will take you all of 20 to 30 minutes in front of a computer. See ya!